Ladies and gentlemen, welcome back to your favorite regulatory news channel, the CRR3 channel of PwC. My name is Martin.neisen and I am your host for today. I am a partner with PwC and I'm also leading the Global Basel IV initiative. As in our previous shows, we would like to investigate a little bit more the content of the European Banking Package 2021. And today I would like to pick out a very specific topic, one topic that is included in the CRR, in the CRR3, and it's related to the calculation of capital requirements, and here a very specific type of risk, and that is operational risk. And like always, I'm doing that not alone. I have a really good expert on the calculation of capital requirements for operational risk today. With me, it's Karina.folvik from PwC Norway. Hi, Karina. Hvordan går det?
Hi, Martin. Det går bra. How are you?
Fine, thank you. Karina, I'm so happy to have you here with me for today and to investigate a little bit more in detail the new standardized approach for operational risk. And I know you are an absolute expert on operational risk. You're an absolutely expert on regulatory requirements. Could you please give us some insights on the main changes with the new EU banking package on operational risk?
Yes, thank you, Martin. I'd love to do that. As you mentioned, recently we received a large document from the European Commission which outlines new capital requirements for the banks in the years to come. And one of the substantial changes which comes with regard to operational risk is that we have a new standardized approach which will replace all existing approaches for operational risks. That is basic indicator approach, the old standardized approach, and the internal model approach, so-called AMA. So that's really interesting news for the banks because the calculation of own funds requirements will be much more aligned across different business models, and we would expect to see much more stable and comparable figures across different banks.
Karina, the old approaches that you just mentioned, they had a range from being very easy to calculate up to very complicated to calculate, especially when we speak about the AMA. How is the new standardized approach working? Could you give some insights on how to calculate, for example, the so-called business indicator component?
Yes, so business indicator component would constitute the main part of the operational risk requirements in CRR3. And it will be calculated as a business indicator multiplied with a certain percentage, depending on the size of the bank. And business indicator will take into account accounting data, actually profit and loss of the bank. And depending on the size of the bank, the business indicator will vary. So what does it take into account? First, it's interest income. Then it's the so-called service component, which would consist of fee income and fee expenses, and operating income and operating expenses. And last but not the least, it's the trading component. So it's trading profit and loss recognized in the P&L of the banks. And then, as I mentioned, the business indicator would have to be multiplied with a certain percentage for the smaller banks that have business indicator below 1 billion euro. The percentage would be 12%, and then it will increase marginally to 15 and 18% when the banks reach the threshold of 30 billion euros or go above it. And also in the original Basel framework, the own funds requirements for operational risks were to be calculated using a so-called internal loss multiplier, which is basically the historical operational losses for the banks. But in the European Commission's proposal, the internal loss multiplier is removed.
Wow, that seems to be a really big change, from the old approaches to the new approaches. You mentioned that the business component, the business indicator component, is largely based on accounting data on the P&L. Does that mean that banks with a low profitability have lower capital requirements? Can that be correct?
I think one of the advantages of the new standardized approach is that it does not penalize different business models, and as it's based on the accounting data and P&L and takes into account different components, both income and expenses, it would be much more stable and aligned across different business models. So, for example, banks with high interest margins would not get higher capital requirements than banks with low margin products.
Karina, thank you very much so far. As far as I know, is that banks that have a business indicator component that is above 750 million euros, they also have to calculate the annual operational risk losses. Can you give us some more details about that?
Yes, Martin. As you mentioned, larger banks that have a business indicator component which is equal to or exceeds 750 million euro would have to calculate operational losses based on a number of detailed requirements. These operational losses would not affect capital requirements, but they have to be calculated for disclosure purposes. And also there is a national discretion in CRR II, which allows national supervisory authorities to remove these requirements for the banks that have business indicator approach, which is below 1 billion euro.
And Karina, you mentioned that the internal loss multiplier that was originally proposed by the Basel Committee was removed in the EU package. And as far as I know, this was a national discretion granted by the Basel Committee more for, how should I say it, underdeveloped countries. Does that now mean that the Commission thinks that the European Union is an underdeveloped country, or why is it removed?
That's a very good question, Martin. When we talk to our clients prior to the publishing of the announcement of the new banking package, I should say that lots of our banking clients were concerned about the requirement to calculate this internal loss multiplier, because it requires 10 years of historical operational loss data, which would be quite cumbersome for a lot of banks, especially small and medium-sized banks. So I think one of the main reasons why European Commission decided to remove the internal loss multiplier is to ensure a level playing field for all the banks in the Union, and also to make it easier for the banks to calculate operational risk requirements.
Okay, that is really a great benefit for the European banks then. Karina, as I said in the beginning, you are an absolutely expert on regulatory requirements, especially on capital requirements and operational risk, and you are part of our global Basel IV team. But you are also from Norway. So my question in your direction is, are there any specific requirements within the EU banking package that are especially critical for Norwegian banks?
Well, thank you for this question, Martin. I think the Norwegian banking market is a very special one. We have 5 million people in Norway, and we have more than 120 banks. So most of the banks are small or medium-sized. And of course, the changes in the banking package would affect most of the banks in Norway, but what we expect to see is probably the changes to the credit risk requirements that would affect the Norwegian banks most.
Yeah, thank you very much, Karina, for that. That's also what we hear from our other experts from other European countries, or even on global level, when they make impact calculations on the Basel proposals. There are some countries that are facing higher capital requirements in the future, others lower capital requirements. So it's not one direction. Yeah, we can't say Basel IV is always good, Basel IV is always bad. And also with regard to the business model, there are some banks that will receive higher capital requirements, others will face lower capital requirements. And that makes it so important for the banks to make impact calculations and test calculations on their own for making important decisions, because the EU banking package will be implemented until the 1st of January 2025. That sounds quite long, but in the end, it's not so long because there's a lot of work to do. And of course, we as PwC, we are more than happy to support you with this implementation and also the test calculations. Yeah, that's it for today. Karina, thank you so much for being with me here today and discussing the important topic of operational risk. I hope you all enjoyed it, and I hope to see you soon in the next regulatory news channel. Talk to you soon. Bye-bye.